All right, so when it comes to the advanced market structure, we have two types of what structures. I get into. We have the complex pullbacks, and we have what the trending market as well, as in the high highs and high lows, right? All right, so simply what I mean is when price is trending up, what we all know is what price from what a series of these high highs and high lows, right? There's a basic knowledge of what market structure that most of you guys know, right? But structure on its own, structure is a topic on its own, right? And on the bearish market, it also forms what series of what lower highs and lower lows. All right. But what most of us don't know is what they don't know that we have a structure in a structure. I get in it. So what I basically mean, we can have H4 structure. Then when you come to H1, is you can have another what structure within the H4 structure. I get in it. So basically, let's say this is a structure on the H4 time frame, right? It's a whole or it's a move on its own, right? But when you dive into the 1 hour, you see that we have something like this inside, right? For this move, right? So on the 1 hour, you see that we have this kind of what movement within this H4 trend, right? So we call this what as a complex pullbacks, right? We call this a complex pullback. So how we read this is, let me show you how we read it. All right. So we read it as on the H4, we always have to what correlate time frames, right? We always have to correlate time frames. So we have time frame correlation. So H4, we have this low, higher high, higher low, higher high, and possibly maybe what's a new higher low before the trend continues, right? Then on the H1, we have this complex pullback inside. It's a complex pullback because what this move over here didn't break this H4 high. Are you getting it? This H1 move over here, which is a high on the H1, right? It didn't break this H4 high, right? So it becomes what a complex pullback. Are you getting it? It becomes a complex pullback. Good. So when you are on the H4 and you want to catch a continuation trade, what you need to do is what you use. First of all, let me show you guys this. We have the premium price and a discounted price as well, right? So when you are looking for buys, we only look to buy at what a discounted price. I get it. So over here between the 78 and the 61.80 is what we call the discounted price, and we have the 50, which is what equilibrium, right? We have the equilibrium price. Then we have the premium price also. When it comes to what selling, when you are looking to sell, we only look for what POIs within our what premium price, right? So this is how to get what a perfect order block for your continuation or reversal trades. Always look for what POI within your what your premium price and your what the discounted price. Never look for what a POI what's below the equilibrium price. No, that will be what a fake out or what an inducement for what the premium price order block or what's inefficiency or IFCs and other stuffs, right? Our entry price, entry model. Good. So right now you are looking for a buy, right? You are looking for a continuation of this trend. What you need to do is what? You just have to flip your discounted what? Fib from your H4 what? H4 higher low to the H4 higher high. Then right now what will happen? Yeah, your H1, which is a complex pullback that you had inside this what H4 structure, is going to be what is going to be the zone where you'll be looking for what your POI at. You can see that if you flip your discounted fib from this low to this high, you can see we have our discounted price over here. And within our discounted price is where you should always look for what your point of interest at. I get it. So the use of Fibonacci is not for what trade entry, but it's for us to identify where a valid POI is. I get it. It's used to identify where a valid point of interest is. It's not used for entry, right? Basically, what most of retail traders and other smart money traders do is what whenever they see a continuation market, they flip their Fibonacci from this low to this high, then they will be like what they'll guess, right? That price is going to what reverse at what either 61.80 or 78.60 or the golden zone, which is the 50 for them, right? So what they do is that what they will place their limit order over there without knowing the exact place that price will be what will be reacting to or will be giving us what the reversal. I get it. So what they will do is what they will place their entry over here on the 61.80, then their stop loss what below the 78.60. In the sense that if price come to the 61, it will tap them in, or when price push further to the 78.60, it's also what tap them in. But you can see that what the stop loss will be wider. I get it. It's almost what 20 pip stop loss, right? And if you're targeting this previous high as your take profit, just imagine, right? You can just imagine the risk to what 1:2, right? It's not a good risk to reward, right? So what we do as what the advanced smart money traders is what we use the Fibonacci to identify or to look for where what price is what is likely to reverse at. I get it, where there is orders line at, right? Whenever you want to buy something, you wouldn't like to buy it at a higher price, right? You always want to have a discount on that stock or item before what you cash on it or buy it, right? So it's the same thing that you apply to this market, right? Right. So what you do is what we will start looking for what we start looking for our point of interest within this discounted price, which is what it can be either an order block or an inefficiency, right? Or on the bigger time frame, it can be inefficiency. Then when you find it to the smaller time frame, you be able to identify what's an order block within. So I call that OBEM, right? OBEM, where you have an inefficiency, right? Then that within that inefficiency, when you scale down to the smaller time frame, you see what's an order block within that zone, right? So you take that place, right, as your entry. Assuming, let's imagine you're having H4 inefficiency. You can imagine the the stop loss level. I get in it. You can imagine the stop loss. It will be wide, right? And you wouldn't know where price will reverse at, right? That's why you need to do it, to always identify and refine that point of interest, right? You have to refine that higher time frame point of interest. All right. So the same thing happens to what the premium market. Let's say you're having what? So you're having a sell, right? Price is selling. What you do is what you use your Fibonacci from this previous what high, lower high to your lower low, right? Then you are going to identify or look for your point of interest within this what premium price, right? Within this premium price, which is between what 78 and what 61.80 is your what is your premium price. So anything below here, you are not what interested. But anything what's above the equilibrium price is what you are what interested in, right? So I've explained that within the H4, within your premium price is where you are always going to look forward for your continuation or your what your point of interest at, right? So let's say this your H4 structure, which price is forming what series of lower highs and lower lows, right? Then within the H1 time frame, we had this what inside over here, right? So we had this complex pullback within this H4, which is one move. But within the H1, we had a complex pullback. So this complex pullback that we had in on the H1 is where what is going to align most of the time with what your premium price, right? So most of the time you'll be able to identify a point of interest on that complex pullback that happened on the lower time frame, right? And you take your what entry over here. So basically this is how to catch or to look for what a continuation trade or a reversal trade or any other stuff. This is how to look for what your point of interest in the market. Okay. So let's move to the chart and let me show you guys example. All right. So over here, you can see that what's on the H4. Let's try and identify this. We had this lower high, sorry, higher low, higher high, higher high, higher low, higher high, higher low. Price failed to create what? New high. Good. So over here you can see this on the H4, one move, higher high, price took out what this high. We have a break of market structure, price from another high, came down again, broke this again. I get in it. Then if price will continue, it has to be what like this again, right? Good. Now let's check the H1 and see. Okay, let's have the markups. Good. Let's check the H1 and see the complex pullback. Right. So in the H1, you can see we have this complex pullbacks inside. And so we have this, had this, before price went up, right? Over here we had this again, this before what price went up again. So all this within the H1 is what we call what the complex pullbacks. Are you getting it? We call it what the complex pullbacks, right? All right. Now let's look at the selling market also. So there's a consolidation, but we can still have what some lower highs and lower lows inside, right? So let's check the H4. So in the H4, we have this as our new what new lower high, right? We have this as our new lower high because price failed to do what to create a new what price failed to create a new high over here, right? So this place becomes a what lower low, lower high, lower low, lower high, lower lower here. So this on the H4 market structure, right? So on the H4, if you're looking to sell, you just have to do it fib. Just have to fib from this lower high to this lower low, right? And what do you see? You can see price coming back inside our premium price over here. Beautiful. You can see after price came inside our premium price, price started to collapse, right? The same thing you do over here, from here to here. What do you see? You can see price price passing our equilibrium, right? So it's also what a good point to look for a sell. But if it's below the equilibrium, then it's not a good place to look for a trade or a point of interest at. Are you guys getting it? Yes. So let's look within the H1 and see the complex pullbacks that we have inside. All right. So on the H1, you can see all this is our H4 H4 market structure, right? Which is our lower highs and lower lows. On the H1, look at what happened. We had this over here. We had this, right? We had this. So on the H1, we had this high, lower low, lower high, lower low, right? Before this. So if you're on the H1, what will you do? You do something like this. And this place becomes your premium price. This place becomes a premium price. So you'll be looking for sales over here. You'll be looking for sales over here. Then what will happen to you? Boom. Took your sell over here. Stop loss over here. What happened? Price reacted to your point of interest. Boom. Took you out. Right? H4 is not strong enough to reverse. So H1 is not stronger enough to reverse a trend. Are you getting it? All right. Meanwhile, you already know we have H4 structure already there. So why should you be focusing on the minor structure instead of a bigger time frame structure, right? So the H1 structure now becomes an inducement towards the H4 market structure. I get it. So you as an advanced smart money trader, you have to know that this place becomes since it's H1, right? It can do something, but not that much, right? So if you are on the 15 minutes time frame intraday, then you can what? Use the H1 as your what? As an entry for you intraday, right? But if you are maybe a swing trader or a day trader, let's say something like that, then you can basically be looking at what? You should be looking at the H4 point of interest. You can see the H4 reverses this, right? You can see 240 pips. I get it. But the H1, look at it, only what? 50 pips, right? Only 50 pips. So you have to know this difference, right? Same thing also over here. Price password equilibrium. So we have our your point of interest over here. You check the H1 also. You can see we have a point of interest above the equilibrium price, which is what? A nice one, a nice what? POI. But if this other block was supposed to be below or somewhere here, which is what? Below the equilibrium price, right? If it's below there, then there's no way you should what? Be looking at this place as your what? Your continuation what? Trade, right? Over here, look at what happened. We had this inefficiency over here. You can see price indeed what? Reacted to this, but not for long. Price went up, took all of them out, right? Took all of them out before what? Price started reversing. So anytime you want to swing a trade, then you should be looking at what? The H4 market structure, H4, H1 and above. From H4 daily, weekly, that's where you can what? Swing a trade. I get it. That's when you can swing a trade. But when you are doing intraday, as most of us do, then we should be looking at H4, H1, 15 minutes, 5 minutes to the 1 minute. I get it. Yes. All right. So we have like 4 minutes. When the Zoom ends, you guys can click on the link again for you guys to rejoin, right? Okay. So basically, we have covered the market structure, and we have covered how to identify what's point of interest also in the market, right? We have done all that right now. So when we are back, we'll dive into the advanced algo market structure. We'll dive into the algo structure, right? All right. So let's do something quickly before time runs out. So we'll talk about inducements, then liquidity also, right? I'll try to summarize everything. Then we'll also have, I'll also do how I analyze the market, right? So
hello, can I quickly ask a question on this?
Okay.
Can I?
Go ahead.
Okay. Yes, you said if we want to locate the POI, that it has to be between the 61.8 and the 78.6, right?
Yes, that's your premium price.
Okay. What if it's above it? Like if it's below the equilibrium, that means it's not going to consider it.
Yes, but if it's above it, it's also what's good. We can have price giving us our POI at extreme. So always when you are identifying your point of interest, you have what the extreme POI and what the decisional point of interest also, right? So sometimes there will be in the situation where you identify or have 2 points of interest at the same time, right? One becomes your extreme and the other one becomes your decisional. Yes.
Okay. So, sorry, lastly, that means the extreme part, it would have, that's for the premium, it would have passed the 78.6.
Exactly.
So at that point,
you can still look for
at that point, we can still look for entry.
Exactly. If there is no point of interest within the 78 and the 61, sometimes what happens is your point of interest will be above it, a little above it. Yes. Something like this.
Okay. So that means there can be another block there or
Exactly.
liquidity. That's if we refine it down.
Exactly. It is sometimes we have candlesticks out, we have other block within the weeks, right? So sometimes what's happened is you can see price playing the extreme of the other block, which surpasses the premium price, which surpasses the 78 and 61.
Okay.
Yeah.
So the equilibrium price is the 50%, but
exactly.
okay.
So anything below the 50